We are live. Hello, everyone. Welcome all of you to Gulaq's December month's Ask Me Anything webinar. My name is Ankit Kejriwal. I'm a senior analyst at Gulaq, and I'm going to be moderating this webinar. I have with me Mr. Vivek Sharma, who is the head of investments at ST Advisors. Every month, we do this webinar where we break down the portfolio's performance of previous months and give you all the updates that we have done in the upcoming rebalance. Uh, Hi Vivek, how are you?
Hi Ankit, I'm good. I'm good. How are you doing?
All good, Vivek.
Okay,
Let's
let's get
begin.
started. Yeah.
So, agenda for today, we are going to be talking about a little bit about who ST is and uh, about Gulaq, which is the retail advisory arm of ST. And then we are going to be giving you the rebalance related updates for December month, and we would be breaking down the performance of November month. And lastly, and most importantly, we are going to be addressing the questions we have received from everyone. Every month we circulate a Google form where anyone can ask us all their questions, and we address them in this webinar. And also, we address the live questions that we get from the people attending the session. So, if you have any question, you can drop them in the comments or in the live chat, and we'll make sure to address them. A little bit about ST. ST is a pioneer in systematic investing in India. We started in 2008, which was just around the time when SEBI allowed algorithmic trading in India. And ever since that, we have been serving institutional clients, high net worth individuals in creating sophisticated investment products using advanced quantitative algorithms. We are present in over six countries. We have received numerous awards. One such award was the NSE Institutional Member of the Year in 2019. And overall, cumulatively, we manage a little over 1,500 crores as of right now. STI, like I mentioned at the beginning, is the retail investment advisory arm of ST. Uh, Gulaq uses the same sophisticated research that we do at ST, and we package it slightly different to fit for the needs of retail clients. So we try to package it in a way which makes it investable for the retail public. So a smaller size investment and a smaller portfolio. We launched in 2020. We are a SEBI registered research analyst, and so far, over the past 5 years, we have served over 27,000 happy customers. A little glimpse of our team. A lot of members work behind the scene, but the two men leading the charge are Sandeep Tyagi, who is the CEO and founder of ST Advisors, and Gulaq. He has done his IIT, he has done his BTech from IIT Delhi and also an MBA from Columbia Business School. He has over 3 decades of experience in portfolio management, analytics, and consulting. And we also have Mr. Vivek Sharma, who's going to be leading this session. He's the investment head at Gulaq. He has done his BTech and MTech from IIT Kharagpur, and he has over 2 decades of experience in trading and investment management. A little disclaimer before we begin the session. ST Advisors is a SEBI registered research analyst, and we just have to make this disclosure that investment in securities markets are subject to market risk, and all the information that we are going to present in this webinar is for educational purposes only, and it's not an investment recommendation. You can see the SIN number and all the registered information down below. Over to you, Vivek.
You, Ankit. Thanks a lot. I'll quickly touch upon our product offerings initially because there are a lot of new investors also and a lot of potential investors who join us for these calls. So I'll take you through the Gulaq gear-based methodology. Now these gears are based on the different risk levels and these are suitable for investors with varied risk profiles. So if an investor, although most of the investors do look at the equity returns of these portfolios and hence subscribe to Gear 6 because it has 100% equity and longer term equity gives the best returns. But now we clearly see a lot of people are looking at other gears also because equity hasn't been giving too much returns and there's been a lot of volatility. A lot of investors now who are looking at gear 3, 4, and 5 also, which has varied amount of that. The higher debt you have, the less volatility you're going to have in your portfolio, and it's going to be conservative. So the returns are also going to be lower. So gear 3, 4, and 5 are meant for somebody who is conservative to moderate investor, whereas 5 and 6 with 80 to 100% equity are meant for aggressive investors. So you should definitely check out other gears because we're finding a lot of people are now subscribing to these gears as well. Then around last year, December, we launched large, mid, and small cap portfolios also. Sorry, this is yeah. This is about the rebalance update. So this specific month we have increased our allocation to small cap substantially by about 23%. So now small cap is highest at 37%, then mid cap 36, and large cap is at 27. So that's a decent change from last couple of months now. Now, in terms of our allocation to sectors, you can see that the change from November is that healthcare, energy, IT, and real estate, and little bit in consumer discretionary, we have increased our allocation, whereas primarily this allocation has been decreased from financials and consumer staples. Consumer staples is now close to zero. Now, one way to look at it is what's the change from November to December, and another way to look at it is what's the allocation of these specific sectors in the BSE 500. So you can see that healthcare, which has only 6.3% allocation in BSE, we are pretty bullish on healthcare and energy, which has 6 to 7% allocation in BSE, but overall these two sectors constitute more than 54% in our portfolio. Whereas others, we are quite bearish. Financials, which is a slightly bigger sector, we are quite bearish on that. So less than half of the allocation we have in financials. And another one is IT. IT is also we are below the weight in BSE 500. So these are the sectors that we are slightly bearish on for this month. Yeah. Now, looking at these factors, it has been slightly consistent theme only for the last couple of months that majority of the allocation is being given to value and rest of it to quality. So this remains constant for last couple of months. These are the two factors that we are focusing on, using which we are now constructing our portfolios, value and quality. Now let's look at the performance. Last 1 year, obviously, the performance has been down. So our models haven't been performing as well as they have performed in the longer term. But overall, if you see the longer term performance of 3, 4, 5 years, or since our going live in May 2020, so it's been more than 5 years and pretty healthy alpha that we have generated over longer term. Obviously, there are there are windows of underperformance in this, but overall, mostly what counts in these is how much value, how much alpha we have been able to generate longer term. I can understand that there are few investors who have onboarded with us in the last 1 year or so, and there the returns have been less than what they expected. Really, looking at the longer term performance. Now, similar is the performance for Gear 5. Gear 5 has 20% debt and 80% is the same portfolio that is there in Gear 6. So the stocks is same. It's only that we have allocated 80%, and that's why if you see Gear 6 is down about 7.5%, whereas Gear 5 would be down less than 5%. And coming to Gear 4, which is down about 1% in last 1 year. So that's the benefit of having slightly more diversified portfolios. And 1 year performance of Gear 3 is actually up. And as you can see this specific portfolio also since May 2020, Gear 3 has only 40% in equity and 60% in debt, but in last 5 years or so, this portfolio has also generated pretty healthy absolute returns also and pretty healthy alpha also. Not to say that this is what is to be expected over last 5 years, because last 5 years were phenomenal in terms of returns. We were just sitting at COVID lows around May of 2020, and since then, obviously, everyone has done very well. Benchmark has also done very well, and our portfolios also have done pretty well. So this is the complete picture of Gear 6543. And in the last column, you can see the multi-cap portfolio. So even see Gear 3 or 4, which has pretty low risk as compared to multi-cap, and it has been able to outperform even the 100% equity portfolio of multi-cap. We also launched large, mid, and small cap portfolios. These were primarily meant for experienced investors who wanted to take specific call related to large, mid, or small cap stocks. For most of the investors, what we recommend is to look at gear-based portfolios in which we allocate between large, mid, and small caps. But there are few very well experienced investors who wanted us to launch these portfolios, and hence we launched it in May 2020. In last year, December. Even these portfolios, last 1 year has been kind of underperformance. We looked at the back-tested returns. These models are quite similar to the models that we are using in the Gulaq portfolios, the gear-based portfolios, which are primarily flexi cap methodology. And here it is targeted towards each individual large, mid, or small cap. Large cap has underperformed in last 1 year quite substantially, actually. Then mid cap also has underperformed in last 1 year, and small cap since inception is kind of break even, maybe just about 1% or so outperformance. Overall, obviously, over longer term, we expect good performance from these. We expect these to outperform. Obviously, not to the extent of back-tested results, but still we expect decent outperformance over longer run in these portfolios. Yeah. Okay. So, Ankit, now we can actually uh, take the questions that we have received.
Sure, Vivek. We have a lot of people asking why the returns have been so poor lately and when should we expect a turnaround. A lot of people also seem to be complaining that the performance that we present in these webinars are
Hmm.
not matching with what they are seeing in their portfolio. So if
Okay.
you could speak on that.
Yeah. So I'll take the underperformance one first. I guess a lot of investors, as I said, a lot of investors have joined us in last 1.5 years, and our performance has been less than expected, less than the benchmark in that time period. Now, it's very hard to say when it will turn around. Really, if I had that kind of insight when it is going to underperform or when it is going to outperform, we might as well give that kind of insights to our investors also, that now we are going to underperform. So this is part and parcel of equity investing, or rather active investing, right? In active investing, in order to generate alpha, we have to be sufficiently um, different from the index. The closer we are to index, the closer our returns will be, both in good times and in bad times, right? So we have to construct a portfolio which is sufficiently different from the index, and we have been able to do that. Now, using this same methodology, we have been able to deliver returns over last 5.5 and a half years, and the results have been phenomenal. In Gear 6, we have delivered. The gross returns are 17%. Obviously, there's some leakage because of brokerage costs, because of slippages, but investors have received closer to 17. It could be 14, 15, whatever that number is, depending on your broker, depending on when you have executed and what scale. Investors have generated pretty good returns using our portfolios. Now, even when we launched our portfolios in May 2020, we just had back-tested results, and we back-tested it for about 12 years or so, and not every year was profitable even in that, right? So there's no way we or anyone for that matter can construct a portfolio which is generating alpha or outperforming the benchmark indices year after year consistently. There's no way anyone can do that really, right? So it's all a game of probability, and depending on the historical results, if you look at our backtested performance for last 12 years, I think our last 5 years performance has been closer to that, what we had expected from backtests. So there I find a lot of comfort that whatever, as per the models, whatever we have expected, we have been able to generate that, right? And that is going to be the case for the future also, right? Although I don't really expect similar kind of overall absolute returns also and similar kind of outperformance over next 5 years, because when we launched this, we were sitting at COVID lows. So obviously, from a low base, the returns have been good. But I would still expect pretty healthy alpha uh, over next 5 years, and definitely there's no way we'll be able to outperform every year in next 5 years. There's very less probability. There's going to be 1 or 2 years where we will underperform, and that's going to be the case with every active manager, right? But what you've got to see is, I think, two things in any active fund: that what's the probability of or how frequently we are outperforming the market. So whether it's more than 50% or not, it's 60, 70, 80, it could be anything, right? So I think for us, maybe it's somewhere between 60 to 70% of the years, 70% maybe of the years we are profitable. So out of every 10 years, seven will be profitable, but 3 years will underperform. Second point that is important is that when we are outperforming, what's the extent of outperformance, right? And when our models are not working, what is the extent of losses we are having? Now, even if you look at historical past 5 years data, whenever we have outperformed, that outperformance is in the range of 10, 20, or 25%, right? And when we have underperformed, that underperformance has been about, say, 5, 10%, 10% maybe of that order, annualized, right? So in that case, I'm pretty happy with what we have done. Even last 1 year has been less than great. But overall, I'm quite hopeful that whatever we have done in the last 5 years, based on that, I'm quite hopeful that next 5 years are going to be good. Only thing is, I really don't know when that turnaround would happen. But looking at the data, whenever that turnaround happens, it happens at a very sharp pace, and the extent of outperformance really is huge. What normally happens is that investors, those investors who are slightly impatient, I can understand that they have been associated, those ones who have just joined us in last 1 year, they haven't seen the results. So it's hard for them to be patient. But I think there's no other way out of it. Time and again, we have seen the investor psychology, the investors who are able to do well over long run, they are more patient investors. They stick with those funds for longer term. That's what I have to say. See, um, the longer you hold in these kind of funds, the extent of outperformance keeps on increasing. Extent of the probability or the chances keeps increasing. So that's what my response. I really don't know when it's going to turn around, but hopefully, as per past, whenever that happens, it's going to be sharp recovery. Yeah, that was first. I think the second part of your question was related to the difference in investor return versus the fund returns that they see. Now, this could happen. there are multiple reasons why this happens. For more than 90% of the investors, the reasons I'm going to mention is one of the reason. If you feel that your reason is not really covered under these reasons, then you should definitely get in touch with our support team and we'll be happy to look at your portfolio and see what is happening. So what happens with more than 90% of the portfolios, why their returns are not exactly matching is there are multiple things. One is the brokerage. So the returns that are shown on small case platform is the gross returns, right? So you've got to pay some slippages on top of it. Slippages when you buy and sell, there's some bid ask spread, which actually you have to incur while transaction. So there are slippages, there are brokerages, and other STT taxes. Uh, these are what everyone has to bear. And if you are not on discount broker, if you are on discount broker, then these costs won't be much. But if you are not on discount broker, full service broker, then your brokerage just could be really high. So that is one thing. Secondly, another common problem that we see is uh, many times investors they don't invest at one go. They invest at the start, but once in a while either they keep doing SIP or in between whenever they feel like they have excess cash or whenever markets have corrected, they put in more money. In which case what happens is your returns are actually different, quite different from the returns that are shown on small case. The exact way you should calculate your returns is through XIRR or IRR, which is the internal rate of return. And CAGR is not really will give you an indication of the returns you should receive if you have invested or even taken out money, right? So those are the multiple reasons because of which uh, your returns actually differ a lot uh, from the reported returns. Now, what I expect is the brokerages, slippages, STT should be, I think, for some it should could be maybe 2-3%. For somebody who is paying very high brokerage, it could as well be maybe 5-6%. Although that is very rare, but it could be of that order as well, right? So definitely look at brokerage. But if the reason is not really mentioned in what I have just spoken about, then I would urge you to please get in touch with our support team and we'll be happy to look at your portfolio and figure out what is happening, where the gap is coming from.
To add to that, Vivek, one another reason why the deviation in the returns happen is because what we present is the CAGR, compounded annualized growth rate. But
Mhm.
what you see on your small case terminal, it's not CAGR, it's your XIRR. XIRR accounts for the
Yeah.
timing of your cash inflows and outflows. So just to give you a very simple example, you may have invested when the portfolio did an amazing 10% return, and then you decided you want to invest in. But the moment you invest the next month, the returns were negative. So because the timing of your investment was poor, your XIRR would be very low as compared to the CAGR which we are presenting, which would be higher because we uh, calculate the return from one point in time to another point in time. We don't take care of the intermittent cash flows. So that is also one of the reason why we see deviation in the returns that you might be seeing and what we are presenting right now.
Yeah.
Another question that we have gotten from a user is interested in knowing why have we named the Gulaq portfolios Gulaq?
Is he asking about the spelling? Because Gulak spelling is Gulaq. Uh, Primarily because, see, we are a quant firm. So that's why we added Q at the end. And the name Gulak, we all really liked this specific name Gulak because it really gels with something to do with money, savings, and maybe investments also. So that's why the name Gulak and Q, why that letter Q is there because we are a quant firm. We do everything data driven using quantitative strategies, and that's why you have Q in the end.
And also the domain was not available for the other spelling.
The domain was also not available. Yeah.
Okay. We have gotten another question from Sahil. He's asking, long back I asked for the data from backtesting. In the backtesting result, what is the continuous time period for which the performance was the portfolio underperformed?
Underperform. Yeah, this is something I don't have right away in front of me. Ankit, would you have backtesting results, or what we'll need to do is we'll need to really look at backtesting and look at the longest period and also the deepest period. What is the extent of underperformance and also the length of underperformance? The longest period where we have been underwater based on the either historical data also and backtested data. Yeah, let's look into it, Ankit. But how do we get back? Can we note down the name of the person so that we will definitely want to get back directly to him also and to everyone else also? So
Sure. Sahil, what you can do is you can reach out to the support team. We will compute the drawdown duration and we'll send you the data as
yeah.
well as the backtested performance. And maybe in the next AMA webinar, we can present that information for everybody in the webinar itself.
But Ankit, I think this is something we can find out very quickly, right? So what we can do is maybe we can just do a quick blog. It doesn't have to be very detailed, but looking at the historical data, whatever insights we find from it, we just put it together and publish it in the blog. So that we should be able to do pretty quickly, right? So let's
Sure,
do
Vivek.
that early next week.
Sure. We have gotten another question from a user is asking, since value and quality was chosen, why everyone there has been so much churn in the portfolio?
That's the nature of the portfolio or the methodology. Really, using the same methodology, we have delivered incredible returns, right? It's just that the stocks that we are selecting every month, it's I think it has to do with how you fine tune your models really. And that fine tuning we cannot really change month on month based on these similar or exactly same methodology. Essentially, we have been able to generate the amazing results based on the same, following the same sectors. It's just that from time to time, it's going to happen that your methodology is not really working in the market. Very hard to find out reasons for that. But for any methodology, it's going to be the case that from time to time, you are going to see that kind of underperformance. Right. And it is about, as I said, how you fine tune these models. It could be very, your fine tune or those parameters could be very sensitive or not so sensitive. Now, there are pros and cons to each uh, these kind of how you fine tune or the kind of sensitivity you have in these models. If you make it too sensitive, अभी ऐसा लग रहा है कि our models are too sensitive and we are changing on monthly basis, but that helps you also in picking the turnarounds. So whenever that turnaround happens, we are able to pick that turnaround pretty quickly, and that's what I said earlier that whenever that actual turnaround happens, we should see good outperformance. It's not happening, but it can happen anytime soon. And the backtesting insights, I think that should also give us some insights as to how long historically these kind of underperformance have lasted. But it's just about how sensitive that parameter fine tuning is, and it has its own pros and cons, really.
Absolutely, Vivek. Uh, Ashwin and Amit had written to us with the queries. They were asking why the minimum investment amount of Gear 6 was changed for this rebalance.
See, this time I think we were doing some routine optimization in the model, and because of which we had this kind of difference in the minimum investment size. Uh, it's not really, it's just a one-time thing, and you please rest assured that this is not going to happen time and again. This was just one-time thing. There were few investors who reached out to us because they were below that 1.5 lakhs and who were unable to rebalance, and we were able to help them out. So If you are having any issues in rebalancing your portfolio, please do reach out to us, and our support team would help you out in rebalancing your portfolio. And this is just a one-time thing, and it should not really happen time and again. This is just a routine optimization that we were doing this time.
Sahil is saying that he's okay with underperformance, but there should be some revival signs in between for a month or two.
See, I think revival science, if you look at uh, maybe past 6 months performance, we have seen some revival signs. Definitely, but it's just like timing the market. It's very hard to pinpoint. Even if you look at the historical data, it will be really hard for us to pinpoint when that revival is going to happen, right? So it's easier said than done, really. Yeah. But I understand, see, it's going, I have been invested in this strategy for long, and there are many investors who have been invested in this strategy, and they obviously would have much more patience because they have tasted those returns earlier. I can totally imagine for new investors, it's going to be very hard to be patient, but there's no other way out, really.
In fact, Vivek, if you remember, we did this study where we studied BSE 500 returns from 2018 to 2023, and the
Mhm.
average return over those 5 years was somewhere around 18%. But if every year you take away the three best performing months,
Yeah.
if you strip away the best 3 months from every single years in those 5 years, then your returns would actually drop down to -5%. So those just 3 months, 25% of the time, those were not only making the returns from -5 to 18%. So 23% return was attributed to just 25% of the time. So it's the very nature of stock market that the returns come in short bursts, followed by a long period of stagnation or underperformance. So again, reiterating the same thing, time in the market is more important than timing the market. So patience is very important.
Yeah.
Uh,
Yeah.
Another question we have gotten from the user is the more frequent change in the portfolio sometimes indicates that the manager has less conviction in the first place. So what do you have to say about that?
You are correct. In case this is a discretionary manager and they are changing their portfolios very frequently, maybe this is true, but definitely not in case of quant funds, really. Quant funds, by their very nature, they have very high churn. And if you look at even historically, one of the best portfolio managers we had, Peter Lynch, Magellan Fund, which gave almost 30% returns annualized during that 13-year period. Uh, Even for them, the churn was very high. It was actually two or three times of what the industry average was at that point of time. So with quant funds, it's very normal that they are going to have high high churn in their portfolios, really. So it's definitely not, that statement is not meant for, I think, quant fund. It's not about our conviction, really. Our conviction is on the model. Our conviction is not on any one stock or sector. That's not how quant funds operate, really.
I really like this analogy of when explaining to this to investors. Just imagine that you are doing a coin toss, and the probability of heads is 60%, and the probability of tail is 40%. If you flip the coin 5 times or 10 times, there is a very good chance that you might actually get heads only 2 or 3 times, or and tails 7, 8 times, or the other way around. But if you increase the number of coin tosses to 100, to 1000, to 10,000, then the actual probability that you're going to realize would be much closer to that 60,
To that
40%
60.
probability.
Yeah.
So with the quant funds, it's a game of statistics, it's a game of probabilities. So the more frequent the churn is, the higher the number of stocks are, the more closer the actual results comes to the expected ones.
And in fact, there's one more positive I find to all of this high churn, some of the people take it slightly negatively also, that see, we don't have, even when we were doing well, we didn't have too many multi-baggers in place, right? So we did this study, and maybe year is ending, we'll again do this study for this year's performance. What happened is that uh, for many of these discretionary funds, if they have, let's say, 50 or 60 names, maybe most of their alpha is being driven by few names, 5 or 7 names only. So the alpha is really concentrated and it's coming from very few names. Whereas for quant funds, if you see, because we are churning that high, our reliance on those 5 to 7 funds is not that much. Our alpha is coming from maybe 15 to 20 funds. So that's why it's in terms of statistically uh, keeping things in our favor, I think it helps really that we have more number of stocks and higher churn. So I think that ways it helps. Obviously, there is the downside in terms of the slippages and the brokerage cost, but there are a few other advantages also. And net, see, again, I'll repeat the same thing, that using that exact same methodology over last 5 years, we have generated almost 17% alpha. Or if you see the initial 4 years, obviously last 1 year hasn't been that great, but initial 4 years using that same methodology, we did great, right? So we've got to again have that confidence on the methodology really. It's not about having confidence on one specific stock or sector. We are quite confident on our methodology that this is a methodology that works by and large over long run. There'll definitely be few periods where it will underperform. Yeah. We have got to sit through it. There's no other way out.
A user is asking, in fact, telling us that he is pretty fine with 1 lakh and we should increase the minimum investment size to make sure that the portfolio is more optimal.
Yeah, see, our recommended, definitely that's what we want, and our recommended size is obviously much larger. It's about 2.5 lakhs or so. Yeah.
Also, we have launched Gulaq Prime, which has a minimum investment size of 10 lakh. With this is only live for HDFC clients so far, but we are planning on making it live for everybody also. So if you are interested with a higher capital size, definitely that portfolio can be suitable for you. It follows the same methodology, but it's going to be less constrained because the minimum investment size is going to be 10 lakhs. So more optimal, more uh, risk and return would be more balanced. The user is Another user is asking, but value and quality was chosen during the last 4 months also. So what is the reason behind the churn?
The churn is primarily because within value and quality also their scores can keep on changing. Now we have 500 stocks in our universe. Now those 500 stocks, because our data is getting updated every month, their scores or their rankings can keep on changing. Either rankings also, and based on that, their weightages in our portfolios will keep on changing. Even if I have just one, let's say one factor, even then I'm going to have a decent churn in that case. Frankly, I think it's pinching a lot because now the performance is also not coming. But that's the nature of this methodology, that these 400 funds you have, 500 stocks you have, when you rank it every month based on the new data, their ranks change quite a bit. And accordingly, the portfolios also would change quite a bit.
To add to that, these 4 or 5 factors that we may present you, these are broad factors. Within these factors, there are multiple parameters, and those parameters can shift. So we constantly shift the parameters, with a broad bucket might be the same. So that is also one of the reasons
Yeah, those
why.
are sub factors really. So there are multiple other sub factors within those factors. So those could change, and accordingly, the stocks would change. So this is definitely a possibility. It's nothing out of ordinary that we are seeing right now. Yeah.
One user is asking what is our plans for the mutual fund launch. We have been teasing that for quite a long time. Vivek, you have any news on that?
And so there are two things in that. One is the mutual fund advisory. So that we have already launched. We have launched a Gulaq app on which you have these model portfolios, and pretty soon we are going to have that portfolio transition, in which case we'll be advising you on what to buy and sell. So if you already have a mutual fund portfolio, using the app we'll be able to advise you um, on on the buy and sell recommendations. So that is one thing that is in part which is already live, Gulak app, and we'll keep on adding new features into that. In fact, that's a nice app. Thousands of users are now using it on a monthly basis to get an X-ray of their existing portfolio. It gives you insights into your own portfolio, about their holdings, about the sector representation, about the rankings of these mutual funds, or overlap or correlation between those funds. That kind of detailed analysis it has, and we'll keep on adding new features to that. Regarding our own AMC, under which we'll be able to launch our own mutual funds, I think that will take time. That's maybe 2 to 3 quarters down the line. So sometime in second half, or maybe third to fourth quarter of next year, next calendar year, we're going to see the mutual funds. Yeah, but that's a slightly longish process, really. But it's definitely, we are working towards it. Definitely, we're going to see something in 2026.
Harsh is complaining that one of the stock is down pretty heavily in the last 4 or 5 days. How do you still maintain confidence in your strategy?
It's about the methodology, the kind of diversification, and this is again, see, one of the things that we tested with the methodology is also that um, if a stock is down pretty sharply, or if a stock is up pretty sharply, and we keep on testing new ideas, new ways to improve our portfolios, but this is something we have tested, that what if I keep a stop loss in my stocks, whatever that stop loss is, let's say 20, 30, 40%. What if I keep a stop loss, and if that helps me improve my portfolio, improve the performance, whether in case of increased returns or decreased risk over long run. What we observe is that in some cases, yeah, one-off cases it improves, but overall, it does not really help us in the portfolio performance, again, both from the risk or return side, and that's why we decided to take against any such step of having specific stop losses in place. The confidence comes not only from exhaustive backtesting, but also from the live results. Even in 5 years, last 5 years, we have had multiple cases where the stocks that we were holding were down, but even in spite of that, in many cases, they corrected or they reverted very sharply back up. In some of the cases, we had to book the losses also. But net, I think having stop losses in this case, anyways, it's a month game, and next month, if it is not performing during the this month, we'll again remove that stock. It will get removed automatically. So it's about how we have performed using this methodology in the past, and this is the kind of exhaustive backtesting we do in our models, that we keep testing all the scenarios and these kind of suggestions that we get from users. Many of them we have already tried it out, but many of them we keep working on it to improve. And this is not only during the time we are underperforming, right? This is a continuous process. Whenever we were doing very well, even at that time, our methodology or the processes that we are following was same, that we have to keep on constantly working on improving our models based on the new information we are getting. So that's a continuous process that we follow all the time, irrespective of whether we are outperforming or underperforming the markets.
Another user is asking, he remembers the time when we had Gulak Wells live for all our customers and is asking, how is Gulaq Prime different than Gulaq Wealth or Gear 6?
It's it's similar in the nature. It's quite similar to Gulaq Wealth actually. It's quite similar to Gulaq Wealth. Only thing is, obviously, because we have learned a lot many things over the past few years, both our models, Gulaq Gear 6 model also, and the Gulaq Prime model, and even the PMS model have evolved and improved over past 3 4 years because of the research we have done. So I think all of these three models, including the Gulaq Prime, is an improved version of the historical models that we released 3 4 years back.
Another user is saying that small case has also now launched the mutual fund small case basket. So when are we going live with that?
Yeah, we are obviously in talks with small case team as well to launch our portfolios there. So pretty soon you are going to see. But as I told you, see these portfolios are these model portfolios are anyways live on Gulaq app. So if you want to have a look at them, straightforward, just head to just download that Gulaq app. It's now available both on Android and iOS, and you should be able to see the model portfolios. And pretty soon we'll launch the advisory service on top of it, that you can just uh, upload your existing portfolio. You'll be able to upload using few clicks. You'll be able to upload your portfolio, and then we can advise you on your existing portfolio. So all of that, model portfolios are anyways live, and the advisory services maybe in next month or so we'll be launching it on the Good Luck app.
We have a question. The user is asking if there is any sort of drastic change in the market, do we do in between a month rebalance?
See, till now we have avoided. I'm not saying that we'll never do. Yeah, but this is a rare case. Maybe once in a while it could happen, but till now in last 5 5.5 years, we have never seen a case where we thought we would want to even discuss that possibility of mid-month. But yeah, in the case of extreme market events, we might do that, but till now we haven't done. Yeah, but we do take care. See, this is something that obviously we are tracking the markets on daily basis. What's happening to the markets, to the sectors, or to the stocks. If there is a really a Six Sigma kind of event, very rare event, where we feel that we should do something in order to protect the portfolios of investors, we would do that.
Absolutely. And we have one another question from Shilpa. She's saying that she has multiple Gulak portfolio subscribed through small case, and she's saying that when she is doing rebalance, stocks of another small case keeps appearing in the rebalance list. So how do we resolve that?
I think I would really advise there's no point having multiple gear based portfolios, Gulla gear portfolios. So, because stocks in them are essentially same. So, let's say if somebody is having a Gulla gear 4 and a Gulla gear 6, it's same as having a Gulla gear 5, really. There's no point paying us double the fees, really, that case. So you should pick and choose. I think that is something that maybe you can even talk to our customer support executive, and he'll be able to help you out with that. I don't think there is any point in having multiple portfolios really. If it is one person's portfolio, I don't see really any reason to do that, frankly. Can you think of any reason, Ankit, why would someone want to do subscribe to multiple? If they are seeing mid, large, or small cap portfolios, then definitely. But having multiple gear portfolios, can you think of a case where it could make sense?
I can't.
Hmm. Yeah, yeah.
Okay, the user has said that she is invested in mid cap and Gear 6. So it does make sense.
Yeah, yeah. Then definitely it can make sense. Yeah. But so what was the question in that case, Ankit? Can you go back to the question?
The question was specifically that she has subscribed to these two small cases, but when she is doing the rebalance, stocks of the another small case, the mid cap, keeps appearing in the rebalance list of Gear 6. So she's confused why this operational error is occurring.
I can't, I don't know. Is this an error or because there could be few stocks which are in both, let's say, Gear 6 and mid cap. So, and the algo takes care of it. The small case app, while rebalancing, takes care of this. People have multiple small cases, and this usually doesn't happen. If this is an error, I think please do reach out to again to our customer support team. We'll have a look and see whether it's actually an error because it hasn't been reported. There are many, many other obviously investors who have subscribed to both gear-based portfolios and market cap-based portfolios and haven't seen any such error really. The app works perfectly fine. So maybe if you it is an error, then definitely please do reach out to our customer support team. We'll have a look and figure out a solution then.
Okay, another user is asking, some of the securities that we are recommending a buy are rated sell by HDFC Securities. So he's interested in knowing how is our methodology different from HDFC Securities analysis.
I frankly have no idea about HDFC's methodology really. But you can check. I think this can happen. This can happen, but do look at the historical returns, the kind of returns. If they have really given very good returns, then just follow those methodologies really. Uh, but do look at historical returns. I think many of these advisors don't really they keep giving out these buy and sell recommendations, but uh, they don't really track their historical performance. I'm not saying that is happening with HDFC, but do check out the historical performance. And if it is good, then it can definitely happen. Our methodology, the kind is I'm assuming quite different than HDFC's. It can happen, and both of them can work also.
We have a question where the user is interested in any particular stock tip within the healthcare segment where he can allocate 21% of his capital.
I'm sure I don't have any stock tip really. Yeah, that's not how we work. Yeah, whatever I know about stock markets, I think, or our team knows about stock markets. It's all there in Gulaq portfolios, right? We are not hiding anything, so I don't know anything extra really, and that's why I allocate whatever I want to allocate to these methodologies. I have allocated a decent part to these portfolios. And on top of that, I really don't want to apply any mind because there's full research team who has done a lot of research and came out with these portfolios. It's very hard to outdo them really by reading few news articles or doing some bit of research. So yeah, I don't have any stock tips really.
That was the expected answer, but I asked anyways. Uh, Another user is asking, is there a way to place limit order instead of market price orders when we are hitting the rebalance from small case app?
No, I don't think there's any way you can uh, place those limit orders. The only way is really manually if you uh, rebalance your portfolios yourself, but that takes a lot of effort and you might miss out on few stocks really if you're doing it manually, either selling or buying. So I don't think even doing manually is really very efficient. And I can understand if the portfolios are slightly large, there could be decent slippages because of these market orders. And that's why, at least in PMS, obviously there is a constraint that we cannot offer PMS below 50 lakhs. But in PMS, that is one of the advantages that we can rebalance those portfolios, send out. We actually do send out limit orders, and that's why we are able to do that rebalancing much more efficiently. But yeah, there's a constraint that minimum amount has to be above 50 lakhs there. But yeah, that's the nature of the ecosystem, that it's not allowed from SEBI's side that broker uh, can place those limit orders on your behalf.
Yeah. And just a clarifying question from Muthu. Is saying that I was not asking stock recommendation, just asking which of Gear 6 stock we have invested 21% allocation. That's a privileged
Oh,
information. I don't think we can disclose the portfolio and give advice on a YouTube channel.
yeah, yeah. For that, I think you'll need to subscribe to our portfolios. I don't think we can do that really.
All right, I think we are done with the questions. Vivek, do you have anything more to add or can we conclude?
So I think we can conclude. I think only thing that I would like to add is um, I think somewhere around mid early part of last year, when we were obviously markets were doing very well, we had seen huge returns from stock markets in all the categories. Uh, One thing I said for multiple AMAs, that the kind of returns that we have been giving and the kind of returns that market has been giving, it's really not sustainable. You can't do that kind of 25-30% kind of CAGR year after year for 10 years or so. So the thing was that we have to really tone down our expectations, uh, because those kind of returns, obviously, if the economy is growing at, let's say, 10-11%, whatever that number is, there's no way stocks or the whole stock market can grow at 25%. Right. So that was, I think, what I had pointed out at that time in multiple AMAs. And we have seen that over last 1 year that, yeah, returns have been less than average. And I think this is the nature uh, that this keeps on happening time and again. But I think the investors that do well, uh, they they are able to keep their emotions in check. And also, what I've seen is over longer periods, whenever we have these tough times, that has turned out to be some of the best times to actually invest. You cannot time the market, you cannot time or pinpoint that this is the low or this markets will turn around. But historically, what we have seen is whenever the market sentiments have been down, there have been a lot of negative news, all of those kind of things. It has turned out to be very good. And I think now valuations more or less are reasonable now as compared to last 1 year. Definitely, there are some pockets where valuations are expensive, but then there are other opportunities also now in the market. So there are reasonable valuations now, and over 3 to 5 years. We can't say what is going to happen in next 1 year, but yeah, over next 3 to 5 years, I think you should definitely expect 12, 13, 14%. Those kind of average returns from the market, I would expect, and hopefully we would be able to outperform them in good luck.
Absolutely. Thank you so much, Vivek, for taking all the questions and breaking down the portfolio returns and all the guidance you just shared. And thank you, everybody, for joining this AMA webinar. Uh, bye bye, Vivek.
Thank you. Thank you, Ankit. Thank you, everyone. Thanks a lot. Bye.